advising clients across the country. Here he is, your host, J. Christopher Boyd.
Welcome back to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, and my office is Asset Management Resources. I'm here with Jeff Perry, an advisory representative with Asset Management Resources.
Happy to be here, Chris. Thank you.
Thanks for being here. And Brian Regan, our firm's chief investment officer. And what's up? Hey, Brian. Hello. I threw on a little bit of a prop for those people watching us on YouTube. By the way, you can find our show posted on YouTube, and you can find us on wherever you listen to your podcasts as well. We post our podcast each week on Spotify and iTunes, whatever it is, Apple Podcast, Amazon, anywhere you get your podcasts, you can probably find us. So hope you're listening there. Please do listen, rate us, all that kind of stuff. We'd love to have that help other people find the podcast. In any case, I put my mask on, my little
your COVID mask,
because the thought occurred to me. I was in the store the other day, and it was about a year ago. Kristen was lying in bed with COVID, and I'm walking through the store, and I looked around. I didn't see a single person wearing a mask. And I thought, a few years ago, we'd have been scrubbing every damn box that came home from the grocery store.
Quarantining the groceries. Yeah.
Yeah. And I just was taking a moment to appreciate how much has changed in a relatively short period of time. It's been, we've gone through a lot over the last few years when it comes to this. And of course, it's worked its way into our financial considerations when it comes to, what's driven markets up and down over the last couple of years. But my reason was just to kind of say, hey, let's step back and appreciate the fact that as much as COVID hasn't gone away, I just was talking, we just had a couple of clients have to cancel their appointment because both a husband and wife have come down with COVID.
Wow.
So it's not say that it's gone, but it is far less of an ongoing concern. And thank goodness for that.
Yes.
Anyway, I don't know, just thought a little bit of levity, but also a little reason to celebrate a little bit of that kind of good news. In a prior occasion, we were talking about debt and college debt, and I'd mentioned a family that was overextended. They were paying for their children's college expenses entirely with debt. And the reality was that this was really creating a struggle for their financial plan. Now, I think there's more to it than that. A financial plan is basically arithmetic, having, less money go out than comes in, or at least enough to cover your costs, And so this is sort of a ongoing endeavor where people have to have a little less go out and a little more come in so that they can put a little aside and have it grow and be prepared for the future. That's at its core all that we're really doing with a financial plan. It's a lot more complex because everyone has their own specifics and there's moving parts. But in any case, that kind of caused me to think we should ultimately also be talking about what do you do when you have a financial plan that doesn't work? To start us off, Brian, you wanted to chime in a little bit on the idea of college debt.
Maybe I'm speaking to the younger generation again here. Tends to be
people before their kids are in college. Yeah.
But, let me bring the conversation back a little bit. I used to be the fiduciary for a pension plan. And the way pension plans work is, that you have this liability that you have to pay off into the future, right? Somebody's going to have to retire. They're going to draw on their pension. It's 20 years out in the future. You invest today to help pay off the pension in the future. Same thing goes with insurance companies, right? If you have a term life insurance, that's 10 years, you're going to pay premiums for 10 years. The life insurance companies, they're going to take those premiums, they're going to invest it. So, in the case of your death, they're going to have the money available to pay the benefits. I don't look at college any differently than that. There's a very, very high likelihood, if that, well, I'm going to speak for myself. There's a very, very high likelihood, I think, that my children are going to go to college. And to me,
I want to be encouraging it, you're saying. Yeah.
To me, it's almost, it just makes sense to save and invest today for the liability that I know is 18 to 22 years into the future. And I want to encourage everybody, no matter how little you can contribute to the 529 plan, contribute to it and do it religiously, because I think the benefits are enormous, and they are they're not just going to help your child, but it's going to help your children's children. And you're going to have, that's how families develop generational type wealth. Sometimes I wonder, I go, how do people afford these giant houses in these towns? And the answer is it's generational wealth, right?
Right.
Their families many generations ago have been, investing in the future of their children and their grandchildren. And
sometimes that's true.
That's the benefit. So if you come with it, the mindset that, hey, look, this is a debt, this is a liability, piggybacking off of the conversation that we had earlier, I know I have this liability in the future. It's irresponsible in my mind not to prepare to pay for that liability that is inevitable.
That's a great way. That's a great comparison analogy, Brian. And I don't say this often, but I couldn't agree more.
That's funny. Elaborate, Jeff.
No, Brian and I, we have a lot of fun with each other, but we usually agree on many things, and this is one of them. If the premise is, what happens if your financial plan doesn't work? If you don't plan for these things, and all of a sudden you're going to say, "Oh, let's decide to pay this hundreds of thousands of dollars expenses," and you don't have the assets to do that, you're actually harming yourself and your own future. And who knows if you even have the ability to pay in this scenario that you're outlining, Chris. And I want to add one more thing, not just the math, because Brian always does a great job with the math, better than I can. But there's a psychological behavioral component to borrowing money and for someone else's benefit, even if it's your children. The children know that you're borrowing money. The children know that they may not know because they observe, or they may know from actual statements that are being made in the family. Every family is different, but these types of situations can not only, they're trying to do good by paying. Generally, parents are trying to do good when they're borrowing money to pay for their child's education. But depending on how it's being handled in any given family, it can cause strife. It can cause guilt. It can cause all these negative emotions that people have when they're trying to do something right, but there could be a negative effect beyond the financial damage that's being done to their own financial plan.
Yeah, I think a lot of times, in this case, when people think like it's a family value to have a college education, and oftentimes parents relate to, well, my parents paid for me and I should do the same. Or alternatively, I had to pay for my college education, so should they, that kind of thing. That there's some of these, whatever it is, these,
no value judgment on that. I mean,
no, but I'm just saying oftentimes that's the driver behind this.
Mm-hmm.
That's causing them to say, hey, this is something that's important. We think it's our responsibility as parents and so forth, that's driving them to want to encourage this, and they should get the best education they can get. But the reality is there's an economic component to this, and not everyone can afford the same educational cost. Now, whether or not there's value in that, that would benefit to that additional cost. One school costs one amount at a public university versus maybe the private institution? Is it worth it? I was going through an exercise with someone saying, well, okay, maybe they get merited and you're still looking at $50,000 of tuition. And if, that's $200,000 of cost plus all the interest, and that's going higher over time, right?
Sure.
And then it takes how much to pay that off, even at a 15-year loan. That's almost $1,800 a month. That's just to pay on the debt if you're able to just call it $200,000, and in reality, maybe it doesn't start right away, so you got some period where it's accumulated, all that kind of stuff. But
right,
Chris, can I ask how they were financing it?
Just student loans.
Yeah, so I might be wrong here, but I think the interest rate for parents is on federal student loans is higher than it is for the student. So you're actually just
and this wasn't federal student loans. This was just like around here it'd be MIFA, somewhere else it's something else. But one of the, or maybe Discover, or it's a private lender.
Yeah,
when you get up to those amounts, they're going to be private loans.
Yeah,
and yet you are right, Brian. Those Parent Plus loans have a different interest rate
cost
configuration than the students' federal loans.
So, if you are doing student loans, I guess my point is if they're doing them federally, they're actually doing a disservice by paying it themselves.
Not that everything ends up in bankruptcy. I seem to say bankruptcy a lot, but student loans, Parent Plus loans are not generally dischargeable in bankruptcy. There's a separate legal standard that they'd have to prove. Basically, they'd have to be living in poverty to have a chance to have them discharged. They're not part of the regular Chapter 7 or Chapter 13 process where these loans would be forgiven if someone did have to file bankruptcy. It's very difficult.
Great point to point out. That's hard to get out from under. So in any case, that's just talking about that college loan scenario. Let's just talk about more generally. What if your financial plan doesn't work? My flippant response was, perhaps you will, you'll have to work, you know what I mean? Like until you're 90 or something. But so, and by the way, it's easy for me to say something like that on the radio within an abstract manner when you're actually sitting across the table from someone and it's a challenging financial planning outcome. Becomes really difficult to kind of figure out, okay, we got to really knuckle down and get into this. When someone comes in, most of the times in our case, we're dealing with retirees. They have some assets that they've accumulated. They have a lifestyle that they're accustomed to. And it becomes maybe a little less, burdensome to kind of figure out the math. Usually the math comes out pretty good. And it may be a matter of refining to say, how can we tweak this a little bit to get us just the outcome that's maybe ideal or, improved enough to feel confident. But when you have a situation where there's just not enough, it really comes down to, again, it's arithmetic, money in, money out. So what are you going to do? Are you going to spend less or are you going to make more? Because that's all it comes down to ultimately.
If you have a written plan, a written financial plan that was designed and you got some good advice on it, or you're capable of doing it yourself. And if you're monitoring it each year, I think this is something that is a good point. If you're updating your financial plan each year with your assets, your liabilities, your cash flows, all those things that we talk about all the time, and you find yourself trailing your goals, trailing your number, it's relatively easy to tweak it. To think about it as a big cruise ship or sailing across the sea. If you find yourself off course a little bit and you still have 1,000 miles left in your journey, you can make small adjustments to get there. Yeah. But you're just retiring and your plan looked good, your plan or your financial advisor's plan, and you just go off and totally disregard your spending, totally disregard, your asset allocation, not paying attention, not rebalancing, not staying, not reviewing your plan. You could get to this point where all of a sudden you say, all my money's gone. What's going on? Right. So,
right.
If, step one is if you're off course from where you want to be, make sure you are working with an advisor or fiduciary and make sure that you're reviewing your plan annually and making these small adjustments. It's, to your point, and to your time to go to work comment, Chris.
Hmm.
If you're off course, perhaps you can solve the problem by reducing your spending, or maybe a small part-time job, or maybe downsizing your home, or helping relatives, back to your opening, helping relatives a little less than you planned.
Yep. Start a little later on some of the, when
Right.
you're going to retire, maybe review how your lifestyle costs work. Maybe you can spend a little less, maybe it's a combination of a variety of things.
Instead of 6 vacations a year, maybe 4 will do it for you.
Yeah.
Instead of a new car next year, maybe it's a new car in 3 years, right?
Yeah, that kind of thing.
Right.
I would say this is one of those instances where the ostrich plan doesn't work.
No.
You cannot just stick your head in the sand in this kind of a thing. You will, it won't help. As much as it might be easier to just avoid the problem, you really taking some affirmative action. And people can always say, I wish I'd started sooner. I wish I'd done more, whatever. Can't live that way. It is what it is. So it's just a matter of saying, what should I do now? How much can I do? What can I do? What's realistic? And it may not be as much as you'd like, but keep in mind, this is one moment in time. Things evolve and change over time. So, take one step sort of thing. How do you eat an elephant? One bite at a time, right? That's
Right.
kind of the way to
Exactly.
think about this. Just get started and doing positive, progress in the effort.
I think every person, every couple, every family should have 2 kind of financial documents. In business, we'd call it the balance sheet and the cash flow statement. So in a home, we should have a cash flow statement or a budget. We should, even if your numbers are very positive when you retire, in this example, you have excess cash flow, keep track of your cash flow. Make sure you're within where you want your money to go. You can really get out of hand if you're not watching. And I'm not saying you have to watch it every week, every month, but at least review it a couple times a year and see, we thought we were going to spend $20,000 a year on vacations. We're spending 40. Just be aware of where your money's going. And the other thing is like a balance sheet, or maybe a home, or a person would call it a net worth statement. See how your money's flowing in and out of different parts. How are your assets doing? Are you withdrawing assets too fast, or how are your investments doing? So look at those documents with your spouse, with your partner, or with your advisor, certainly at least once.
Yeah. And
Right.
let's jump in there. It's a good opportunity to say, if you need help, get help. We're one of many firms that can be a resource to you, but certainly reach out to Asset Management Resources, amrfinancial.com, and reach out to us by phone at 508-771-8900. We're happy to be a resource to you, whether it's in your financial planning or portfolio management, and let us be a resource for you. Okay, thanks, guys, for an interesting discussion. Until next time, keep striving for something more.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.